I'm Emily Chang, and this is Bloomberg Technology. Coming up, Bitcoin bears and the bubble theory. Cryptocurrency critics smell blood in the water after prices come crashing down. Our deep dive into the 4-day sell-off. Plus, validating an Apple urban myth, the real story behind older and slower iPhones, and the lawsuits starting to pile up. And the boardroom battle between two chip makers, Qualcomm's latest attempt to avoid a $105 billion hostile takeover, and the bitter proxy fight spilling into 2018. But first, to our lead. Bitcoin investors may be having a reality check. The cryptocurrency fell almost 30% Friday to below $13,000. Bitcoin has lost close to 40% this month, but it's still risen more than 11-fold this year. Also happening earlier, one of the world's largest cryptocurrency exchanges, Coinbase, said all buying and selling was temporarily disabled after having delays in processing wire transfers and verifying new customers for the past week due to higher traffic. These issues just reignite the question, are we in a Bitcoin bubble? Joining us now in New York, Techonomy CEO and our guest host for the hour, David Kirkpatrick. Also with us, our Bloomberg editor-at-large, Corey Johnson. So let's start with what's going on in Bitcoin this week.
So I created a Bitcoin monitor on my many Bloomberg screens, and I've got a Bitcoin monitor. I've been monitoring a bunch of these stocks as well. I'm working on a Bloomberg News story coming soon to a Bloomberg terminal near you. Check that out shortly.
I will.
About one of the Bitcoin stocks. But today was weird because I kept noticing the price looked like it was up for me today. And actually, since this morning, since the beginning of New York Stock Exchange trading today, it's not a stock, but most prices in the U.S. start with a 9:30 quote in New York. Bitcoin's up, and it's up big today. It's up about 24% since 9:30 this morning, New York time, 6:30 our time. So basically, since I've been awake today, Bitcoin's been rallying after a little bit of a sell-off, or after a big sell-off, I should say. And I think what this really highlights is the enormous volatility that is still extant in this, the trade of Bitcoin and a lot of the other cyber currencies, and then added to that a lot of the equities that have been formed around this idea of blockchain and Bitcoin. Because despite the futures contracts that are trading now in size in Chicago.
And yet you still have the skeptics. Mike Novogratz, the hedge fund manager, had this to say about his Bitcoin plans. Take a listen.
This is a bubble, and there's a lot of fraud mixed in. There's a lot of froth and fraud in anything that's as exciting as this. So I think this is going to become the biggest bubble of our lifetimes by a long shot, mostly because it's so global.
I want the record to show I didn't say that.
Mostly because it's so global.
He also said he is shelving plans for a cryptocurrency hedge fund. David, look, where do you fall? I've asked you every week where you fall. After this week, where do you stand right now on Bitcoin?
My basic views haven't changed, but it's very, I think, important that someone like Mike Novogratz, who's a very well-respected investor and whose enthusiasm for Bitcoin has been used by many as a legitimizer for the idea that this thing could go to the moon, is himself now saying it could be the biggest bubble of his lifetime. So I think that's a very healthy thing, because what we have here is something that almost certainly is going to be worth a lot at some point. But there is no objective reason why it should be worth any given amount at any given moment, in my opinion. I mean, people say it could go to $1 million, 400 million. I mean, people have thrown out crazy numbers, and any one of them is equally valid, including zero. So until Bitcoin settles down and it becomes much clearer what, if anything, it's actually used for in the world, I think the volatility is a consequence of genuine uncertainty about what people are buying, and that will continue.
Nobody knows how to value it.
Could
be zero.
Dave. Kirkpatrick's so unnecessarily positive. He just said any prediction could be valid, which is to say every other prediction is invalid, which is to say any prediction here is invalid. And I think that that's really the case here. The idea of what the price will be before we have fully functioning usage of Bitcoin is nuts. And it's pure speculation, not based on, particularly as you see a lot of retail accounts coming to this, not really understanding what this could be, looking at volatility, looking at a price rise. You know, I joked that I wish I put all my kids' college fund into Bitcoin a few months ago, or a few years ago when I first looked at Bitcoin. But the truth is that would have been foolhardy, because there's no sort of underlying value in what, you know, there's possibility, to be sure, in a handful of cyber currencies, but in terms of an intrinsic value here, it doesn't exist, just as intrinsic value in things like gold and silver doesn't necessarily exist. Yes, there are some use cases, but the intrinsic value is really in the eye of the beholder, or a greater fool's theory. As Warren Buffett has often pointed out, all the gold in the world is worth much more than all the farmland in the U.S., and yet the farmland in the U.S. will be far more productive than all the gold in the world.
David, what do you make of these companies that are simply adding the word blockchain to their name, or buying blockchain companies, or you know, getting into cryptocurrency in general because they think it's the hot thing?
You mean like Long Island iced tea that became Long Blockchain yesterday and had its stock double?
You read my mind.
I think that's proof that there is no rational reason for a lot of these changes, and what's happening is people are getting really irrationally excited and, to use the word, greedy in hopes of short-term gains, and they're taking advantage of mass psychology, which is frenziedly trying to get in on what seemed like a sure thing for about 5 minutes. I mean,
Okay,
Corey could have done a great job for his
made,
school fund if he'd invested at 9 o'clock this morning and sold as the show was starting.
If there's money to be made, though, why not?
Well, if you're interested in day trading and you have an incredible stomach for rapid volatility and risk, you know, I think that's fine. It is kind of a harder thing to trade in and out of than some things, investable items. So, I mean, I continue to think ordinary people who are just trying to protect their long-term and financial future should not be investing in this thing. I do think long-term it's a historic transformational technology that will have a lot of value. Will it have millions of dollars per Bitcoin in value, or will it have a few hundreds of dollars per Bitcoin in value? I don't know. It will have value.
So, Corey, you know, the crash we've seen this week, week. Is this the beginning of something, or is it just going to continue to go up in the new year?
There have been massive price falls and rises in Bitcoin since its very beginning. Falls of more than 20% over and over again with this currency. It looked like we hadn't seen one in quite a while, but yeah, in a week down 19%. That's not remarkable for Bitcoin at all, and we've seen that a lot. Now, one would have thought the futures contracts would have provided a little more grounding around that, stability around that, the ability to be long and short, this ability to sort of predict prices in the future. What's interesting about the way the futures contracts have traded thus far is they are predicting them in their first monthly expiration next month a much lower price in Bitcoin, and I think that really is a reflection of the vol on this. We'll see if there's a lot more trading around it and how many new coins will be minted. There, of course, is a limit on the total number of coins that will ever be created, and that has people sort of believing that there will be some ultimate scarcity in this, but scarcity does not always provide value.
So what questions are you going to be asking and exploring going into the new year?
Well, so look, you know, there's two things, right? So the silly stocks we're talking about, I love these stories. And I think that one of the things you want to look at, though, is the market cap of what we're talking about here. This Long Island iced tea thing, who cares? It's got a tiny little market cap. But there are companies out there with market caps of over $1 billion that claim to have a real business here. I don't think they pose a systemic risk right now, but I do think that they're extraordinarily risky for shareholders. And there's a lot of money in and around these things. They're worthy of examination.
Some of these are multi-billion-dollar companies.
They're worth an examination to see what's really there. But that's separate from the use of blockchain. And I think the usefulness of blockchain is going to be very interesting going forward. I think the ultimate solution here will be the day that they can trade currencies. I'm sorry, they can trade stocks using blockchain technology to record the series of transactions. If we were able to do that with stocks, that would be a dramatic change in the way all of Wall Street works.
All right. Corey Johnson, our editor-at-large. Thank you. David Kirkpatrick, CEO of Techonomy, and my guest host for this hour. You are sticking with us. Well, more banking executives are moving to crypto startups. A Morgan Stanley director is leaving the company to join a cryptocurrency trading firm. Wayne Trench is set to join Octagon, which buys and sells virtual currencies, including Bitcoin, Ethereum, and Bitcoin Cash for clients. Also moving to the same company is an HSBC exec, Andrew Davidson. The moves come as crypto trading builds momentum among institutional investors, and products are lining up for regulatory approval. Coming up, why Apple customers are heading to court over complaints of slowing iPhones. That is next. Bloomberg Tech is live streaming on Twitter. Check us out at Technology, weekdays 5 p.m. in New York, 2 p.m. in San Francisco. This is Bloomberg. A California judge has sanctioned Apple in the Federal Trade Commission's lawsuit against chipmaker Qualcomm. The judge says Apple has been withholding documents related to the case since a December 15th deadline, resulting in fines of $25,000 a day. Apple is not a party in the FTC suit, but has its own legal action pending against Qualcomm. Sticking with Apple, iPhone users have taken their complaints to court, infuriated by an Apple software update that slowed down the operation of their smartphones. At least 2 groups of customers sued Apple over the deterioration of their phone's performance. Apple acknowledged this week that it issued a software update that slows down iPhones with dying batteries. The fix was supposed to help people get more out of their aging batteries and reduce occurrences of unexpected shutdowns, according to the company. But customers don't seem to be buying it. Joining us now from Minneapolis, Loop Ventures co-founder and longtime analyst covering Apple, Gene Munster, and still with us, guest host for the hour, David Kirkpatrick. So, Gene, I am so curious to hear what you think about this story. The older iPhone shutting down has happened to me. This has long been a conspiracy theory among users, and Apple released this statement in response to a report about this happening. What's your take?
Well, I think you need to take a step back and just play the conspiracy theory through, is that if Apple is slowing down the phones for the purpose of that you'll buy a newer version phones, that to me sounds like a risky business approach. And the reason is that to make your product worse in the hope that you buy a more current product, they run the risk of people saying, I don't want an iPhone, let's go over to Android. It seems like not the best approach. So I think at face level is Apple was in a catch-22 here. They did the right thing for the performance of the phone. I do not think this was some sort of a conspiracy theory, but there's no easy way around it. When you connect the words slowing down the phone, people immediately are going to react to that. I would say that consumers vote also with their dollars. And if you look at the aftermarket pricing on, for example, Craigslist or eBay of iPhones, they have consistently, even though they've been slower, those older phones, held their value much better than an Android phone. So I think that, yes, it's an issue, but I don't think it changes fundamentally of how people think about the phone.
David, should Apple have been more transparent about this from the outset?
Well, absolutely. The problem, in my opinion, is one that we're seeing more and more from the big technology companies that are acquiring a heavier and heavier role in society and in our lives, is they're really not very good at communicating about what they're really doing, because historically they haven't had to. And as I think we become more dependent on their products and services, and as the demand grows for explanations for why they do things, they don't have any practice in explaining that stuff. So I don't think Apple did the wrong thing based on the evidence that I've seen. However, what they did wrong is not volunteering the information that they were doing it and waiting until users essentially outed them, and then the press forced them to acknowledge it. I think that's the mistake, and it does seem to be very parallel to the kind of thing that Facebook and Google face in refusing or being unable to explain how their algorithms work, what they think they ought to be the solution for things like fake news, et cetera, et cetera. Finally, sometimes they'll make a little progress if you force them. But these companies don't want to basically take responsibility and give transparency to what they're doing.
Gene, people are still going to buy iPhones, of course, but how do you expect these lawsuits, class action lawsuits, to go down?
Yeah, I don't think they have any merit. I do want to just say David's spot on. That was that the issue around this was how Apple handled the message on it, not being forthright. But as far as, this has given some people some opportunity where they see dollar signs here. Everyone knows $270 billion in cash that Apple has. Easy to take a shot at them. I think I will make a large bet that these lawsuits go absolutely nowhere.
All right. You do have a new note out talking about Apple's M&A philosophy. We've seen a couple of buys and investments lately. You know, what is the strategy you see playing out here?
Well, they're going to be repatriating a lot of money with the new tax policy, and it's probably going to be close to $210 billion is going to come back, and which begs the question, how is that going to change Apple's M&A philosophy? And the simple answer is it will likely have no impact on it. Apple has never had a cash problem. Having an absurd amount more cash in the U.S. doesn't fundamentally change that. To answer your question, is what their strategy is typically to acquire technology sub-billion dollar. They've done some things like Beats that have been more than that, but in general, they don't buy brands, and we think that they're going to continue down that pace. You look at the Finisar investment, if you want to call it that, that was kind of in that same framework. And so I think that if you're looking for a blockbuster M&A deal in the next 1 or 2 years from Apple, I think it's a very low probability. A lot of the same kind of the singles and doubles kind of an M&A strategy in the near future.
All right, Gene Munster of Loop Ventures, always great to have you here on the show. Thanks for stopping by. David
Thank you, Emily.
You are staying with me. All right, coming up, Qualcomm pushes back against Broadcom's takeover plans once again. What is next for the rival chip makers? This is Bloomberg. Qualcomm continues its attempts to keep Broadcom's takeover desires at bay. Qualcomm's board is opposing the nomination of 11 new directors by Broadcom. Broadcom is currently attempting a $105 billion hostile takeover offer of its rival chipmaker. Qualcomm originally rejected Broadcom's initial $70 a share bid that its CEO says, quote, isn't even in the ballpark. Joining me now, Bloomberg Intelligence's legal analyst, Matt Larson. So what do you make of Qualcomm's rejection of these directors today?
You know, I think Qualcomm is looking at their business. They're looking at where the company is. They're looking at the Apple dispute and their licensing business and saying, you know, we've been hit pretty hard. There's a lot of cash on the table that we're hoping to collect. And the trading price now is not indicative of the value of the company. And so from a Broadcom perspective, you're looking at the company, you're seeing some additional value there if you can clear up some of the legal overhangs. And it's a good time to try to put a bid in. So I think it's wise for Qualcomm to try to fend those off.
So if this takeover were to happen, how would it proceed?
So the way that things are shaping up now, Qualcomm has rejected the bids, and as a response, Broadcom is looking to insert some members on the board of directors. There's a vote that'll happen in March, and so we'll kind of see how that plays out. We could see some additional Broadcom interests on Qualcomm's board that will then attempt to sway shareholders, and then you may see additional bids in an attempt to actually to move forward with a takeover
Now,
process.
talk about the legal pressure facing Qualcomm from Apple, from the FTC, and other regulators.
Yeah, Qualcomm is under tremendous pressure right now because of the way they segment both their chip business and their patent licensing practice. There's a lot of scrutiny. There are allegations that Qualcomm overcharges for its chips because it essentially has some kind of monopoly power. It contributes to standards that are required in order to connect cell phones with wireless internet connections, 3G, 4G LTE, looking down the pipe at 5G. And so as a result, Apple and the people who make Apple devices are not paying Qualcomm's licensing fees, saying they're usurious, ultra high because of Qualcomm's leverage that it has because of these patents. So Qualcomm's in a hurt. It's not getting any licensing business right now. It's looking to resolve that through litigation, but the time frame is long. These legal disputes take a long time, so we're looking at really the third quarter of next year before we see any progress in these legal disputes.
So, you know, interestingly, a judge fined Apple for not turning over information fast enough in, you know, an adjacent dispute. What do you make of that?
Yeah, that's right. This is in the FTC's lawsuit against Qualcomm. In this dispute, Qualcomm needs to get documents from essentially all of its licensees, all the people who it's in other disputes with, to provide evidence as to whether or not they've breached obligations or abused the monopoly power as a result of holding all these patents. Apple's been producing documents, about 2.5 million, I believe it says in the pleadings, but they've got another 1.6 million documents to turn over, with depositions coming down the road and a pretty fast-paced trial schedule, even though you know, we're looking at things, again, coming to a head kind of at the end of next year. Apple needs to get these documents turned over. There are deadlines that are breached, so it's essentially just the judge saying this needs to happen fast, and starting to impose some monetary sanctions as a result of not turning the documents over. David
Kirkpatrick, CEO of Techonomy, is still with us. David, what do you make of all of this activity happening in the chip industry? Lawsuits, hostile takeovers, and all of these various disputes?
Well, I think in the case of Qualcomm, Broadcom, Qualcomm is one of the companies that sort of created the world we live in. They have spent an enormous amount on R&D, and as we're moving into this amazing world of 5G technology, which is just on the very near horizon, they're going to help make that possible too. I think of them as one of the great innovative companies. Meanwhile, Broadcom is a much more financially oriented, roll-up type company trying to gain short-term financial advantage, roll one more big thing into its portfolio and boost its stock. There's other things about it that I question, but I think that the industry is not loaded with players that have fundamentally advanced social progress, and I think Qualcomm is one. So I see it unfortunate that this company has been so burdened by so many different legal problems. As Matt pointed out, I mean, the number of issues that surround Qualcomm is very, confusing for investors.
Right.
So it's a good time for Broadcom to jump in, but I frankly think it's unlikely they'll succeed in the long run.
All right, David Kirkpatrick, my guest host for the hour. You're sticking with me, Matt Larson of Bloomberg Intelligence. Thank you for stopping by. Coming up, the venture capital outlook for 2018. We will hear from Ethan Kurzweil of Bessemer Venture Partners on where he's looking to spend next year. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang. SoftBank's record-breaking $93 billion vision fund has changed the venture capital landscape, and the effects can be seen in the U.S. According to people familiar with the plan, Sequoia Capital is said to be in early talks to raise a new fund that could potentially top $5 billion. So, how do mega funds impact VCs next year and further down the line? For a look at the broader landscape, joining us is Ethan Kurzweil, partner at Bessemer Venture Partners. So, Ethan, so first of all, how has the SoftBank Vision Fund changed the competition or changed the landscape internally?
Well, thanks for having me, Emily. I think it's really way too early to know that today. They're just figuring out their processes, they're figuring out what they're going to invest in. But I think there's really two things going on fundamentally. One is that companies are staying private a lot longer. You've talked about that a lot on your show before. And so SoftBank is kind of like the mechanism now to take some companies public. But then also there's companies that aren't quite ready to go public that are getting a lot more capital than they're used to, and that is going to take some time to play out. Do they spend it efficiently, or do they waste it and create inefficient businesses that aren't strong,
right,
aren't sustainable?
So my question, is this a good thing, or is this could this lead to some bad results in companies that shouldn't staying afloat? The
latter thing will absolutely lead to that. Even companies that should stay afloat, not taking the right actions to create good businesses, because if you're getting $300 million on your balance sheet, you don't cut costs, you don't create the same efficiencies that you might otherwise. So it's not necessarily bad businesses staying afloat, it's companies not being incentivized to create good fundamentals to become great businesses. And that could absolutely have an impact on the results of those funds and how startups operate.
And clearly there's a lot of interest to invest in tech. I mean, Sequoia raising potentially a $5 billion fund? That's huge.
Well, I think
that's a lot of money.
Tech's generated a lot of headlines. There's a lot of excitement around tech, and there's not that many other places to place money. I mean, look at blockchain and how much money has gone there all of a sudden. So I think it's a sort of capital allocation game right now, and over the next decade, some of that money will be well spent. They'll get more money to spend, and some of it will be wasted, and that'll be, and there'll be some consequences of that long term.
Given all the money flooding the system, how does that change things at Bessemer? Is the landscape more competitive? Is there just more money out there than ever chasing deals, which means you have to up your game or change strategy? Is strategy changing at all within your firm?
Well, we try to keep our game high at all times, and we're fortunate in that we can invest at any stage. And so it absolutely forces us to reevaluate our strategy and figure out, all right, are we going to compete with SoftBank for $1 billion+ deals? No, probably not. We're going to move to a part of the capital to the stage game that we can be more effective. Now, we have our roots as an early stage investor, and we can invest very early on, or we can go late. Where we sense more competition, we tend to shy away from those rounds because we don't think they'll be the kind of returns that our investors are expecting.
So where are we in the cycle? You know, there was talk of the bubble of 2014, and it seems that every year things get even frothier, and now companies have even more money in their coffers to spend.
Yeah, people have been calling the top of the cycle for 7 years now, and so people much smarter than me would have to give you a prognostication on that. I don't know. I do know we're definitely at an all-time high in terms of frothiness and some of the money going into companies that are just not that mature, and so it does feel like we're due for a pullback. But again, that prediction's been coming for 5 years, and so at some point something will give, but you need a trigger, and I couldn't tell you I know what that is at this point.
So I know you're really interested in esports. You made a big bet on Twitch, which Amazon bought for $1 billion. What are your big bets for 2018?
Well, we're looking a lot at the esports ecosystem, both teams, enabling technology, platforms. There's a lot of people whose time and attention is spent in esports. It's actually going to surpass most traditional sports over the next couple of years in terms of viewership. 80 million viewers of this most recent League of Legends World Finals recently. So it's a big audience for this, but dollars have not yet come in the same proportion as baseball and football, but that will happen. And so,
who is this audience? Who's watching?
I mean, the most predominant, as you would expect, is millennial men, but that's not it. I think it's something like a quarter of all millennial men watch esports, but then it transcends beyond that because these audiences are fairly big and diversified at this point.
So what do you see becoming the biggest platform for esports?
Well, I think right now it's a battle between Twitch that you mentioned earlier, Facebook and YouTube in terms of the viewing of esports. And then there's a couple of other market participants. There's the sponsors that are getting involved in esports, as well as platforms for the play, the actual gaming platforms. The most prominent which are Riot Games' League of Legends right now, and then Blizzard with Overwatch League has their own entrant in esports, and we'll see. And there are other upstarts that'll contribute to that as well. So those are the games that people are playing right now.
You mentioned Facebook, which is diving into original content, and I know you're also looking at media bets. Where do you think where are you positive on media bets, and where do you see sort of those going awry?
Well, I think anywhere there's content with lots of rabid viewership being created, that's where I think that's where the money is going to flow ultimately. Now, some of that goes to very high-end premium content. I'm less bullish on that because I think that's been really expensive to produce, and requires a very long sort of payback cycle for investing.
You mean like Netflix and Amazon Studios?
Exactly. Those require very long time horizons. For startups, things like Twitch work, where it's user-generated content, people playing games that's created every day and that has this rabid fan base around it. And so I think there's different types of gaming experiences that have that same characteristic. There's different kinds of media that have that same characteristic where it's fundamentally user-generated, but people love it and will watch it.
What about something in between? CNN, for example, had a special show on Snapchat, but today they announced they are ending that show or taking a pause, as they say. What do you make of a move like that? Is that bad for Snapchat?
Probably. I think it says more about Snapchat than anything else. I think that's a good move for CNN. And it's also good that they experiment a lot, and probably they couldn't get the form factor to work, or they couldn't get the experience to work on Snapchat. And that probably just tells you more about Snapchat not being a medium that CNN could connect with viewers on, or could create something with a sustainable business around, and so they've elected to pull back. I imagine that kind of experiment will work, though, in other formats. I'm not sure what it will be.
All right, so where will you be putting your money in 2018?
Well, esports, media, consumer, everything around entertainment, where it's new types of entertainment, and to the extent it's user-generated, that tends to be create more opportunities for startups.
And where won't you be putting your money? What do you think is frothy right now?
Premium content is something I and we at Bessemer have always avoided, very frothy. And late stage rounds where you're competing with the kinds of investors you mentioned earlier, we'll probably be shying clear of those as well.
All right, Ethan Kurzweil, Bessemer Venture Partners. Great to have you back on the show.
Thank you, Emily.
Thanks for stopping by. All right, coming up, a leadership change at Alphabet was just one of the top stories this week in tech. Just what else made the list? Find out next. This is Bloomberg. It's official. President Trump has signed the GOP's $1.5 trillion tax plan. Republican leaders claim this will be a boon to the economy, but one person who disagrees with them is the president of MIT. Listen to what he told Bloomberg in an exclusive interview.
It means less money for all the things we're expected to do, less money for financial aid, less money for support for our grad students, less money for research, less money for innovation education. I mean, it is a very surprising move.
MIT officials estimate the tax bill will cost the university $10 million per year. Well, the news of Eric Schmidt stepping down as Google's executive chairman rocked the tech world Thursday, and a source has told Bloomberg that former Stanford University president John Hennessy is a likely candidate to replace Schmidt for the chairman role. We sat down with Bloomberg Tech's Brad Stone and Alistair Barr to talk about that, the frenzied week in cryptocurrencies, and the news that Uber CEO has picked a new right-hand man.
Well, he needs to fill out this big bench, basically, that's been decimated this year by all the scandals. So this is a really good hire for him, and he's bringing on people that he's already worked with, so he's familiar with them. And this guy basically took a company that was pretty debt-laden and not doing very well, and built it up to be quite a rival to Expedia, which is the company that Dara ran. So he seems like a very good operator.
So presumably, as Dara travels around the world trying to put fires out in places like Europe, for example, Barney Harford can hold down the home front. Speaking of the EU, very big blow to Uber this week, ruled that Uber must be treated as a transport company, not a tech company, essentially a huge blow to the equivalent of UberX, which is Uber Pop.
Right. What it means is that Uber drivers need to get licenses. And what we know is UberX in the States, anybody can drive their own car, pick up passengers. Actually, Uber hasn't operated in that way in Europe for a long time because of some of these earlier rulings. So taxi drivers have to get licensed. It caps their growth. It means they can grow less slowly, and it's a challenge for Uber.
So have to talk about Bitcoin. Coinbase today halted buys and sells. They're now back up and running, but of course a massive plunge. Everyone's saying, is this the bubble popping? Which, who knows? But, what do we know about the malfunctions that happened today?
Well, I think it goes to the heart of the problem of Bitcoin, which was it's an amazing idea, but the actual technical plumbing of how it works, it makes it actually quite slow because there's no central party to confirm all these transactions, but the way it's confirmed in a decentralized way slows it down a lot, and that's a big part of the problem.
At the same time, this is a company that is now investigating insider trading on its
so
own
Coinbase,
platform,
which is kind of the populist way to buy and store Bitcoin, the CEO has said that they're investigating insider trading. I mean, to me, this is the Wild West, and we shouldn't be surprised that there's illicit activity going on at the OK Corral. But it's another sign that this is poorly regulated. There's no oversight, and that people are getting away with a lot. And if you bought in the last couple of weeks, you're hurting right now.
Meantime, big news, Eric Schmidt is stepping down as executive chairman of Alphabet. He's becoming a technical advisor, this after a 17-year-long career at the company. What is the story here? Why do we think this has happened?
Well, there's the obvious thing, which is that there's this Alphabet reorganization 2 years ago, which he helped a lot with. It basically put the founders in charge and a lot of these new leaders. He's not so important anymore. That's the official reason. There may be some other reasons to do with his life outside of Google and his work. In the politics arena, he was very, very close to the Democratic organization. He also had a bit of a run-in with an antitrust research organization pretty recently as well, and that caused a bit of a scandal. So there are certain things in the past year that may have precipitated this.
In this climate, Brad, I think a lot of people are asking, is there more to this story?
Well, look, it's true that there has been inordinate amount of attention on people's personal lives and their kind of behavior in the workplace. It's a fact that Eric Schmidt has been separated from his wife for many years. They have an open relationship. He has entered into relationships and brought girlfriends to company events. I don't make any judgments about that, but certainly we are in an environment where people are making judgments about it. So perhaps, and they have not said that this is so, but perhaps it's just safer to have him not be in that front man chairman role.
Meantime, companies like Google are, in a way, it seems trying to hit reset right now in this new climate. And, there are new leaders like Sundar Pichai who has emerged. And interestingly, in the statement that Larry Page shared yesterday, he mentioned himself, Sergey, and Sundar as sort of the leaders of the company. And I thought it was interesting that they brought Sundar into that.
Yeah, and he came from basically a generation of Google leaders who came up through the company. Some of those people actually left under a similar cloud, but Sundar has emerged relatively unscathed, and he seems a pretty straightforward operator. And so I think he's the perfect person to lead at least the Google part of the business through these issues.
And we could add that also on the board, John Hennessy, the former president of Stanford, kind of a godfather of Silicon Valley. You know, they haven't announced Eric Schmidt's successor as chairman, but Hennessy, it seems to me, would be a natural successor.
Yeah. That was the Week in Tech with Bloomberg Tech's Brad Stone and Alistair Barr. Coming up, a lawsuit in Beijing mirrors the hotly contested dispute between Alphabet's Waymo and Uber. We will bring you all the details. This is Bloomberg. Elon Musk's SpaceX will cap a record year tonight with the launch of a rocket carrying satellites from California's Central Coast. It will be the company's 18th mission this year. That's more than any competitor, and more than twice as many as last year. Baidu is suing its former autonomous driving chief and his months-old startup for allegedly stealing in-house technology. Now, if this storyline sounds familiar, the lawsuit echoes a dispute between Alphabet's Waymo and Uber over allegations a former executive took valuable data when he jumped ship. China's largest search engine provider is suing the company Jingche, led by former Baidu executive Wang Jing. Joining us now, Alex Webb of Bloomberg Tech, and still with us, our guest host for the hour, David Kirkpatrick, CEO of Techonomy. So, Alex, heard this story before.
It does seem to ring a few. It seems to have a certain amount of deja vu, I think.
Exactly.
The thing is, actually, in this space, what we've seen is a huge number of startups being given a lot of money. And so it's happened to any number of leaders of these groups. They've thought, well, why should I take a paycheck which to us might seem huge, but to them it's relatively small compared to how much they could raise going elsewhere. And perhaps this is a case where he's done much the same, gone out, raised $52 million, and started this company. Now, that's much what happened with Google, or Waymo as it's now called. Andy Lewandowski left, set up a company of his own, which he then sold to Uber for a significant sum. Those guys have been sued for technology theft, allegedly. They're doing the same here.
David, what do you make of this? Obviously, we know that the war for tech talent has always been fierce, but now specifically in the self-driving realm, it seems the stakes are even higher.
Well, allow me to be a little bit cynical because, first of all, we don't think of China as being the hotbed of intellectual property protection, so I wouldn't expect that legal action is going to yield all kinds of fruit in that area, first of all. Second of all, you know, a lot of things are done for effect in this arena, and China spends enormous amount of time thinking about Chinese companies and the Chinese government thinking about how can we seem to be better than or as good as American tech companies. So Baidu is, you know, more attentive to Google than even you and I are. So I think it probably serves their interest tremendously well to be seen as having the same problem that Google had, and suing this guy in the exact same way that Google sued its veteran executive who left. But on the other hand, when I look at, I don't know anything about the case, but I look at his investors, Jiming Venture Partners and NVIDIA, those are extremely reputable investors. I can't believe they would have invested in his company if he was the kind of guy who was walking out the door of Baidu with a lot of IP that it didn't belong to him. So to me, the whole thing smacks of a PR exercise.
That is interesting. Yet it has happened before.
Yes, I think the one element here you do have to consider is they are clearly competitors, right? And one upshot that we've seen of the Waymo Uber case is that it has created a certain amount of headwind for Uber's development. You know, they've lost some talent. Lewandowski himself has left.
It's a huge headwind.
Exactly. So it's made it harder for them to achieve their goals. Now, you could look at this much in the same context. Baidu sees a quite well-capitalized competitor, perhaps more nimble than Baidu is because it's smaller, leeching talent from them, and they are trying to find a way to put up a few buffers for them.
talk to us a little bit about Baidu's approach to self-driving cars, the open source approach.
So it was quite funny, actually. We had so we've done this graphic. We've been trying to update every quarter, every 6 months of all the alliances between every single company in the autonomous driving space. Baidu then comes out and announces several dozen partners in this project called Apollo, where they're borrowing intellectual skills from some rivals, some people with different skill sets, and which rendered our whole map of all these companies completely redundant because they have got more partnerships than anyone else. Now, I'm always slightly wary when anyone ever calls anything open source because, you know, think about Google's AI stuff. There is clearly some agenda there and perhaps driving people towards Google Cloud. So completely open source, not quite, but they are lending a lot of the technology to other people.
All right, David, last question. We've got about a minute left. Self-driving cars were a big theme this year, as were cryptocurrencies. You know, what do you expect to see in the self-driving car realm in 2018?
A massive continual progress, probably some legal progress to allow these things to operate on more roads. We're going to start seeing them on the streets in limited areas. I think it's one of the most promising arenas of technological progress in the world right now. It's going to be limited, but it's going to be very important, and I put a lot of importance on it.
Yes? Gay?
Next year, one thing that's really interesting is going to be the continuation of the kind of businesses that support autonomous cars, the traffic management systems, what they call V2X, these sort of traffic lights that can talk to cars, and that's really going to be a lot of capital flowing in there.
All right, we will be watching. Alex Webb of Bloomberg Tech. David Kirkpatrick, CEO of Techonomy, thank you for being our guest host
Happy
today.
holiday. Thank you.
Happy holidays to you. Happy holidays to everyone watching. We'll be back next week. That does it for this edition of Bloomberg Technology. We will see you on Tuesday.